Today is Saturday, February 28th, 2026, and right now, as you're watching this, 1.21 million ounces of silver just vanished from COMEX vaults. Gone. In a single reported session. And here's the part that should genuinely stop you cold. Silver is sitting at roughly $87 to $94 per ounce right now. That is $30 below its all-time high of $121.67, which it hit just 30 days ago on January 29th. So here's the paradox that nobody in mainstream media is connecting for you. The vaults are draining at a historically alarming pace, and yet the price looks like a discount. If you look at that and think, great, I'll just wait, stop. Stop and watch this video. Because what is happening inside COMEX right now is not a normal inventory cycle. It is something far more significant. And by the end of this video, you will understand exactly why these vaults are emptying, who is taking the metal, who is selling the paper, and what this specific drawdown of 1.21 million ounces actually signals about where silver is heading next. Let me say that again so it sinks in. Silver hit $121.67 on January 29th. It is now trading around $87 to $94. That is a 28 to 33% drop. And in that same period, COMEX registered silver, the metal that can actually be delivered against futures contracts, has dropped 23.8% over the past 30 days alone, with 27 million ounces withdrawn. The price is down. The metal in the vault is also going down. Think about what that means. Both are moving in the same direction. That should not happen in a healthy, balanced market. That should make every alarm bell in your head go off. Let me briefly introduce the channel for anyone watching for the first time. This channel covers silver and precious metals markets with real data, real sources, and real explanations of what is happening beneath the headline price. We do not do sensationalism for its own sake. We look at actual exchange data, actual vault reports, actual delivery numbers, and we explain what they mean. If that is useful to you, subscribe and hit the bell, because this kind of data moves fast and you do not want to miss the next update. Now for returning subscribers. In our last video, we highlighted that COMEX registered silver was already entering what analysts call stress territory, with the coverage ratio falling toward 15%. As of today, that coverage ratio stands at 13.1%. We called that trend weeks ago. Now here we are. Let that sink in. Let me explain what COMEX registered inventory actually means, because if you do not understand this, the rest of the video will not make sense. And I promise you, once you understand it, you will never look at a silver price chart the same way again. COMEX is the commodity exchange in New York. It is where futures contracts for silver are traded. Now, a futures contract is essentially a paper promise. You agree to buy or sell a set amount of silver at a future date at today's price. Each standard COMEX silver contract represents 5,000 troy ounces of metal. But here's the critical thing to understand. Most of these contracts are never settled with actual metal. Most of them are closed out for cash. The buyers and sellers never actually touch silver. This is what people mean when they talk about paper silver. It is a financial claim on metal that, in the vast majority of cases, never becomes real metal changing hands. But some contracts do demand physical delivery, and when they do, the metal has to come from what is called registered inventory. These are the bars sitting in COMEX-approved vaults, JP Morgan, Brinks, HSBC, in New York, Chicago, and Delaware, that have been formally designated as deliverable. They have warehouse receipts against them. They are immediately available to settle a futures contract. The other category, eligible, is silver that also sits in those same vaults and meets the quality standards, but it belongs to someone who has not offered it up for delivery. They are using the vault as secure storage. The CME does not control that metal. So when we talk about registered silver dropping 1.21 million ounces in a single session, we are not talking about some accounting reclassification. We are talking about metal that was available to back paper contracts, physically leaving or being deregistered from the deliverable pool. Now watch this. Right now, as of the latest data, COMEX registered silver sits at approximately 82 to 110 million ounces, depending on the specific day you're reading this. Against that registered pile, there are roughly 500 million ounces of March 2026 open interest. Do the math. That is 5 paper claims for every single ounce of real deliverable metal. 5 to 1. Some analysts tracking this in real time are putting the leverage ratio at 7.6 to 1. At the current withdrawal pace, registered silver would be exhausted, meaning completely gone from the deliverable pool, in approximately 64 trading days. That is just over 3 months. Read that again. 3 months. Now let me show you the evidence from multiple directions, because I do not want you taking my word for any of this. I want you to be able to verify everything yourself. Start with the COMEX data directly from CME Group, which publishes daily warehouse stock reports. You can find these at cmegroup.com under delivery reports. The data shows that since late 2023, COMEX registered silver has fallen from approximately 346 million ounces down to where it sits today. That is a decline of over 70% from the peak, over 70%. And the pace of that decline has been accelerating. In just the past 30 days, 27 million ounces have been withdrawn. That 23.8% drop in a single month is one of the steepest short-term drawdowns in the system's recorded history. Now go to the Shanghai Futures Exchange. Bloomberg reported in late November 2025 that silver inventories on the SHFE had hit their lowest level since 2015. And this is happening while China is one of the world's largest consumers of physical silver. The country uses silver in everything from solar panel conductors to electronics to EV batteries. China's combined SHFE and Shanghai Gold Exchange inventories have been declining for months. The Chinese silver price in yuan per ounce is up 164% over the past year. That is not speculation. That is real demand pulling real metal out of real storage. Now look at the London market. The London Metal Exchange has historically been a massive pool of silver liquidity. Those inventories have collapsed to historic lows as well. And because of the dislocations created by tariff uncertainty in early 2025, silver was literally being air freighted across the Atlantic. Flown, not shipped, because the premiums justified it, from London to New York to meet COMEX delivery demand. That is an extraordinary logistical response to an extraordinary supply strain. Now look at December 2025 delivery data from COMEX itself. In just the first 4 trading days of the December contract, 47 to 48 million ounces stood for delivery. Let that sink in. 47 to 48 million ounces demanded in 4 days. Historically, an entire December delivery cycle would see 10 to 20 million ounces. They saw double to triple that in 4 days. One analyst quoted by Felix and Friends put it this way. In December, 47 million ounces were claimed for delivery in 4 trading days, which is like 60% of all the silver inventory. That is not a normal delivery cycle. That is a run. And then there is the lease rate signal. Silver lease rates, the cost to borrow physical silver, spiked to more than 30 times their normal levels during periods of acute stress in 2025. Let me repeat that, 30 times normal. When the cost to borrow silver goes up 30x, it means nobody wants to lend it. It means the people holding physical silver are not willing to part with it even temporarily because they know what it is worth and they expect demand to intensify. Lease rates are not a manipulated number. They are a pure market signal of physical tightness. Now here's the part of this story that mainstream financial media is almost completely ignoring. And I say almost generously because most outlets are not touching this at all. Pay close attention. Look at when the silver price drops happen. Look at the time of day. Consistently, the largest sell-offs in the silver price occur during U.S. trading hours. The January 29th all-time high of $121.67 was followed by a sell-off that, as the U.S. Treasury Secretary Scott Bessent himself said, attributed extreme swings in the metals market to speculative activity, though he pointed the finger at Chinese traders. Now that is an interesting deflection, because here is what the physical data actually shows. While the paper price was being pushed down during New York trading hours, the metal was flowing out of the deliverable pool. The registered inventory was shrinking. Physical silver was being taken out of the system. Stop for a second. Think about this. If you were a large institution, a bank, a trading house, a sovereign wealth fund, that genuinely believed silver was going to $150, $200, what would your strategy look like? You would want to acquire as much physical metal as possible. You would want the paper price to be as low as possible while you did it. You would not be advertising what you were doing. You would be very quiet about it. Here is what the data actually shows us. One side of this market is selling paper silver during U.S. hours, pushing the quoted price down. The other side, primarily in Asia and the Middle East, is withdrawing physical silver from every available global exchange, COMEX, LME, SHFE, at a pace that has brought inventories to multi-year and in some cases all-time lows. One side sells paper, the other side accumulates metal. This is not coincidence. The timing is too consistent, too systematic to be coincidence. And now add the Mexico factor. Mexico is the world's largest silver producer, contributing approximately 202.5 million ounces, or 6,300 metric tons, in 2025. That is roughly 1/4 of all global silver mine production. In late February 2026, the killing of Jalisco New Generation cartel leader El Mencho by Mexican security forces triggered retaliatory violence across multiple Mexican states, including regions with significant silver mining operations. That is 1/4 of global supply now operating under elevated jurisdictional risk. Think about what that means for an already structurally tight market. Think about what that means for the 82 to 110 million ounces sitting in COMEX vaults. Now let me give you the historical precedent, because markets have short memories, but history does not lie. In 1979 and 1980, the Hunt brothers began accumulating physical silver on a massive scale. They ultimately controlled an estimated 130 million ounces. As their buying intensified, COMEX registered inventories dropped sharply, lease rates exploded, and the price went from under $6 an ounce in 1979 to $49.45 in January 1980. That is an 800% move in roughly 14 months. The COMEX eventually introduced what was called Silver Rule 7, which restricted the ability to buy silver using leverage, effectively forcing a liquidation. The price collapsed. But here is what is different today. The Hunt brothers were two individuals using debt. What we are watching now is not two people. The physical demand being documented is coming from industrial users, sovereign buyers, ETF inflows, and institutional investors across multiple continents. And there is no Silver Rule 7 equivalent that stops a solar panel manufacturer in China from needing real silver to make real panels. You cannot regulate away industrial necessity. The Silver Institute's data shows the silver market has been in a structural supply deficit for 5 consecutive years. From 2021 to 2025, the cumulative deficit reached 800 million ounces. That is nearly a full year of global mine production that was consumed without being replaced. Above-ground stockpiles have been drawn down to cover that gap, and now those stockpiles are running low across every major exchange simultaneously. This is not a short-term market dislocation. This is the consequence of 5 years of consuming more silver than the world produces. Let me talk directly to the different types of people watching this video right now, because what you should do with this information depends entirely on your situation. The first type of person is scared. You bought silver when it was heading toward $120. You watched it fall to 75, recover to 87 to 94, and you were sitting on a loss or barely breaking even. You were thinking about selling. You want the pain to stop. I understand that feeling. It is a very human response to volatility. But before you act on that feeling, look at what the fundamental data says. Registered COMEX silver is down 70% from its 2020 peak. 5 consecutive annual deficits. Lease rates 30x normal at stress peaks. Industrial demand from solar, EVs, AI data centers, and semiconductors running at 650 to 700 million ounces per year against mine supply of 820 million, meaning the gap must be filled by drawing down inventories that are already at historic lows. Selling into a fundamental supply crisis because the paper price temporarily retreated is, with respect, letting short-term emotion override long-term evidence. The second type of person is confused. You understand that something significant is happening, but you do not know how to evaluate it. You have heard silver is important, you see the vault data, but you are not sure if this is a story that matters or just noise. Here's the clearest way I can frame it for you. When the cost to borrow silver goes up 30 times, when 60% of total COMEX inventory is demanded for delivery in 4 trading days, when 5 exchanges across 3 continents are simultaneously drawing down their physical stocks, when the world's largest silver-producing country faces escalating cartel violence. These are not coincidental warning signals. These are data points that all point in the same direction, toward a market where physical supply is increasingly strained against demand that will not shrink because it is baked into the global economy's transition toward clean energy and technology. The confusion is understandable, but the data is not ambiguous. The third type of person already understands the dynamic. You see what is happening. You are watching the paper price and the physical data diverge, and you understand that the paper price is the temporary one and the physical reality is the permanent one. For you, the current price level between $87 and $94, still $27 to $34 below the January 29th all-time high, represents what your response to it should be. A decision you make based on your own financial situation, your time horizon, and your capacity to hold through volatility. What you should not do is confuse temporary paper price weakness for a fundamental change in the supply and demand picture. Because the vault data shows the opposite is happening, let me talk about where this goes next. Based on the structural deficit data, the current withdrawal pace from COMEX registered vaults, and the acceleration of industrial demand, here is what the trajectory looks like. If registered silver continues drawing down at anywhere near the current pace, the March 2026 delivery cycle is going to be extraordinarily stressed. The ratio of open interest to registered supply is already at a level, 5 to 7.6 paper claims per ounce of real metal, that has historically been associated with delivery squeezes. When delivery demand exceeds available registered supply, exchanges have two options. They can increase margin requirements, which they already did during the 2025 run, just as they did in 1980 and 2011. Or they can allow cash settlement in lieu of physical delivery. If either of those things happens at scale, it does not resolve the fundamental problem. It just delays it, and, critically, it signals to every large player watching that the system is under genuine stress, which accelerates the very behavior that created the stress in the first place. The price target that most analysts tracking the physical market are working with is a return toward, and likely through, the January 29th high of $121.67, once the March delivery cycle plays out and the coverage ratio continues declining. The timeline on that is uncertain. Markets do not move on clean schedules. But the structural pressure is not going away, because you cannot manufacture silver that does not exist in the ground, and you cannot substitute silicon for silver in a solar cell. Now step back to the paradox we started with. 1.21 million ounces just left COMEX vaults in a single session. The paper price sits around $87 to $94. 5 paper claims for every ounce of deliverable metal. A coverage ratio of 13.1%, deep in what the exchange tracking community considers stress territory. Lease rates that hit 30 times normal during acute squeezes. 5 years of cumulative deficits totaling 800 million ounces. Shanghai, London, and New York inventories all declining simultaneously. And Mexico, 1/4 of global supply, now operating under escalated security risk. The paper price says one thing. The vault data says something completely different. In the long run, physical reality wins. If you found this breakdown useful, subscribe to the channel, because this story is moving fast. The March 2026 COMEX delivery cycle is going to generate data we have not seen before. I will cover every significant development as it happens. Drop a comment below and tell me this. Do you believe the COMEX can handle the March delivery cycle without a forced cash settlement event? Yes or no? The comments on that question are going to be very telling. I will see you in the next video.